In 2025, Russia spent $190 billion on its military.
Right, which is just a massive number.
Yeah, I mean, that's 7.5% of their entire gross domestic product. It's the highest military burden in the country's recorded history. And, while you might think that number just belongs in a war room somewhere.
Like on a map covered in territorial lines.
Exactly. We are actually going to show you exactly how that specific data point is right now, quietly draining the purchasing power of the money sitting in your checking account.
It really is a staggering mobilization of resources. I mean, when a major global power dedicates that much of its economic engine to kinetic output, it creates this intense gravitational pull.
Yeah.
It fundamentally reshapes global trade, sovereign debt markets, and even just the underlying value of fiat currency itself.
And so that's our mission for this deep dive because, most of the mainstream coverage of global conflict, it focuses on the visual reality of war, right?
The troop movements, the tanks.
Yeah, satellite imagery of artillery strikes, that kind of thing. But what we are looking at today, using this massive stack of sources we've got, and we're talking economic research briefs, central bank risk assessments, historical financial data, what we're looking at is the silent plumbing of the economy.
The underlying architecture.
Right. We're mapping out exactly how the threat of European conflict transmits directly into the financial reality of ordinary life. Because the money is already moving, the impacts are already happening, and honestly, most people haven't even noticed.
Well, and that's the thing. The financial consequences of a geopolitical crisis, they don't wait for a formal declaration of war.
No, of course not.
They certainly don't wait for tanks to cross a physical border. Financial markets are, at their core, predictive engines. They price in systemic risk way before the general public notices any real shift in their daily lives.
Yeah.
By the time the average person realizes, that their financial position has been compromised, institutional capital has already entirely repositioned itself.
Which means this isn't just some abstract economic theory we're kicking around today.
Not at all.
This is about your savings account. It's about your pension. This is about whether or not you can actually afford to buy a house or what your daily purchasing power is going to look like 5 years down the road.
Exactly.
But to understand how we arrived at this precipice, we kind of have to trace the structural timeline first. We have to look at the baseline assumption that governed the European economy for, the past 30 years?
Yeah, the past 30 years.
Yeah.
And that baseline assumption was, simply put, permanent peace.
Right. The end of history.
Right. Following the collapse of the Soviet Union, Europe essentially built its entire modern public finance system on this premise that large-scale, industrialized, state-on-state conflict was just a relic of the 20th century. It was universally known as the peace dividend.
And that dividend, it wasn't just a metaphor. It was cold, hard cash.
Oh, absolutely.
If you look at the data from, say, 2004 to 2014, defense spending as a percentage of GDP actively fell across almost the entire European continent. They were totally cashing out.
They were.
And think about what that money bought. The European social model, right? The extensive healthcare systems, the subsidized infrastructure, the green energy transitions.
Robust pension networks.
Yes. All of that was heavily subsidized by the fact that these nations were not out there building fleets of fighter jets or stockpiling millions of artillery shells.
They structurally bet their sovereign balance sheets on the idea that major wars were over. And, even when that assumption was aggressively challenged, like when Russia was actively rebuilding its military capacity during that exact same window, or when they tested their hybrid warfare doctrine in Georgia back in 2008.
The inertia was just too strong.
Exactly. The inertia of the peace dividend was overwhelming. European nations just continued to prioritize domestic social spending over military readiness.
And then 2014 happens, the annexation of Crimea.
Right. A huge wake-up call.
NATO officially looks at the landscape and says, okay, we need a guideline here. Every member state needs to spend at least 2% of their GDP on defense. But if you look at the research, it shows that even after Crimea, only 3 out of 27 member states actually met that 2% threshold.
It's incredible.
It's like the system simply couldn't accept the reality of the changing environment.
Well, reversing a multi-decade structural trend like that is politically agonizing. Entire domestic economies were completely reliant on that capital flowing into social programs. To suddenly pivot and tell voters that their infrastructure projects or, their social safety safety nets are being scaled back to fund military
Yeah,
procurement.
that's political suicide in peacetime.
It is entirely unpalatable. Governments will naturally delay that kind of pain until the reality of the threat makes it absolutely unavoidable.
Which brings us to the massive, undeniable reality check of 2025. Because the numbers from this year, I mean, they literally look like typographical
They
errors.
really do.
European NATO members increased their defense budgets by 14% in a single calendar year.
14%, yeah.
That brought the total expenditure to $864 billion. And the historical data in the sources confirms this is the sharpest annual growth in defense spending since 1953.
And 1953 is such vital context here. That's right in the aftermath of the Korean War. We are witnessing a mobilization of capital right now that simply has not occurred in over 70 years. It is a complete paradigm shift in how Western democracies allocate their resources.
And the specific national shifts really illustrate just how severe this panic is. Take Germany, for example.
Like Germany?
For obvious historical reasons, Germany has been incredibly hesitant to militarize for the better part of a century.
Yeah.
Yet in 2025, German defense spending hit $114 billion. They pushed past the 2% GDP threshold for the first time since 1990.
It's a huge psychological threshold for them to cross.
Yeah, and Spain. Spain saw its defense budget rise by 50% in a single year, hitting over $40 billion. And finally, after a decade of dragging their feet, all 32 NATO allies met that old 2% benchmark.
But what it's truly telling about the current environment is that the exact moment they all finally achieved that 2% target, the geopolitical situation had deteriorated so badly that they immediately realized it was totally insufficient.
Right.
So at the Hague Summit in June 2025, NATO allies established a brand new target, 5% of GDP by 2035.
Moving from an unmet 2% to a mandated 5%, that is just a staggering commitment of future capital. And the European Union is actually stepping in to orchestrate this at the supranational level, right? They launched this mechanism. It's called the SAFE Facility. It represents $150 billion in EU-backed bonds, specifically designed to fund arms procurement, and it's structured to be repayable over 45 years. Plus, there's the broader Rearm EU mobilization, which aims to channel $800 billion into the defense sector over the current decade.
And here is where we really must transition from just observing the military reality to dissecting the fiscal reality. Because terms like EU-backed bonds or mobilization of funds, they sound so bureaucratic.
Very sterile.
Very sterile. But $800 billion does not spontaneously generate out of thin air. A central bank's printing press doesn't create actual wealth. It only dilutes and distributes existing wealth. Every single euro spent on this historic rearmament is capital that has to be extracted from the existing economy.
It has to be pulled from somewhere. And looking at sovereign balance sheets, governments essentially just have two levers to pull, right? They can borrow it.
Which means issuing new sovereign debt.
Right, piling onto the immense debt loads these nations already carry. Or they can redirect it, which means actively defunding public housing, healthcare, education, or infrastructure so they can go buy air defense systems and munitions.
Those are the only two mathematical realities available to them. And this brings us to the concept of opportunity cost on a macroeconomic scale. The exact same national government that guarantees your bank deposits, the government that ultimately backstops your pension fund, is now simultaneously transforming into the largest arms procurer in European history.
Yeah.
They are stressing their own fiscal capacity to an unprecedented degree.
Okay, let me play devil's advocate here for a second. Because there is a very persistent narrative, it's like the classic high school history class version of World War II, that argues military spending is actually this massive economic stimulant.
Oh, the wartime boom theory.
Exactly. The story goes that factories open up, assembly lines start rolling, unemployment drops to zero because everyone is building tanks or aircraft, and the economy just booms. So why are we framing this rearmament purely as a financial burden? Doesn't a wartime economic boom create actual wealth?
It's an incredibly common misconception, but it's fundamentally flawed. What you are describing is essentially a macroeconomic application of the broken window fallacy. Okay, unpack that.
Sure. When you look at specific, isolated sectors like defense contractors, aerospace engineering, heavy industrials, they absolutely experience a boom. Their order books are full, their margins increase, they hire aggressively. But the broader aggregate effect on the entire economy is a severe drain on actual wealth.
Because of the nature of what is being built.
Precisely. It's the nature of the output. Think about it. If a nation goes into debt to build a high-speed rail network or a massive fleet of agricultural tractors, those assets go on to produce compounding economic value for decades. The tractor helps grow food year after year. The railway facilitates commerce. The debt taken on to build them is eventually serviced by the economic growth they generate.
Right, they pay for themselves.
Exactly. But if a nation goes into debt to build a cruise missile, that missile is fired, it detonates, and the value is permanently destroyed in an instant.
Wow. Yeah, the physical asset is just gone, but the financial liability remains. The debt incurred to build that destroyed missile sits on the national balance sheet for 30 years. So while defense workers temporarily have well-paying jobs, the broader population pays for that non-productive destroyed output.
How do they pay for it?
They pay for it through two primary mechanisms: either higher explicit taxes to service the lingering debt, or, more insidiously, through systemic inflation as the central bank prints currency to cover deficits the government cannot finance through taxation alone. A wartime boon is very often just an illusion that masks the rapid real-time consumption of a nation's underlying capital base.
So the money you have sitting in your checking account is quietly buying less and less, even if the nominal number on your screen stays exactly the same. You're paying for the security fortress through quietly shrinking grocery portions.
Yes, the nominal stability of fiat currency hides the extraction of its purchasing power.
But the wild thing is, you don't even need to wait for governments to officially run out of money or for 30-year bonds to mature to see the system buckle. The market does the math instantly.
It does?
We don't have to theorize about how a geopolitical shock impacts the everyday market. We have live empirical stress tests from the recent past. We saw this play out in real time on February 24, 2022.
The day Russia launched its full-scale invasion of Ukraine.
Right.
That day serves as a perfect laboratory for observing the immediate transmission of geopolitical trauma into the global financial architecture.
The numbers from that single trading session are just historically significant. $1 trillion was erased from global equities in a matter of hours. The MOEX, which is the Russian stock exchange, crashed a record 33%.
Massive.
The World Economic Forum later noted this as one of the 3 largest single-day stock market crashes in recorded history. And the commodities markets, they reacted with sheer violence. European gas prices surged between 40 and 50% before the trading day even closed. Oil effortlessly crossed the $100 per barrel mark.
And that is the instant, visceral repricing of energy risk. The market immediately understood that the foundational input of the European economy, which is cheap, accessible energy, was fundamentally compromised.
But what is really revealing to me isn't just the public stock market panicking, it's what was happening underneath in the hidden plumbing of the banking system.
Right, the silent tightening.
Yes. The research brief highlights this study from the Center for Economic Policy Research, authored by Theft and his colleagues. They analyzed banking data immediately following the invasion and identified this phenomenon they termed a silent tightening of monetary conditions.
This is a foundational concept for understanding how ordinary people are actually affected by distant conflicts. Normally, when we discuss monetary conditions tightening, we picture the European Central Bank or the U.S. Federal Reserve making a formal public announcement.
Right, like a big press conference.
Exactly. The central bank governors meet, they decide the economy is running too hot, and they officially raise interest rates to cool down lending.
It's deliberate. It's telegraphed to the market months in advance.
But the CPR researchers demonstrated that a severe geopolitical shock completely bypasses that entire bureaucratic process. The February 2022 invasion generated a direct, immediate balance sheet shock for European commercial banks that had exposure to Russia, or even just to energy-intensive industries. Their internal risk algorithms instantly registered that their existing asset portfolios had become highly toxic or completely inaccessible.
So they didn't wait for a central bank press conference. They just went straight into survival mode.
They moved to protect their core capital immediately. To do that, these commercial banks unilaterally raised their own internal funding costs. And more importantly for the broader economy, they immediately and severely restricted their credit supply. They tightened their lending standards overnight.
Wow.
So if you were a mid-sized manufacturing firm in Milan or a bakery in Frankfurt applying for a loan to expand operations on February 25, 2022, you suddenly found credit vastly more expensive or entirely unavailable. Not because the European Central Bank changed its policy, but because commercial banks were terrified by a conflict 1,000 miles away.
The geopolitical shock bypassed the central bank entirely and just strangled the commercial credit supply. It compressed the aggregate demand of the entire real economy in a matter of hours. And, if we look at the second stress test in the research, the 2026 proxy war in the Middle East, we see a similar mechanism, but it traps the central bank in a completely different way.
Yeah, the 2026 Middle East conflict serves as the perfect model for regional shock contagion and its specific impact on inflation.
Within weeks of that conflict escalating, the Euro STOXX, which is the broad index measuring European equities, fell more than 10% from its peak. The euro itself weakened 2.9% against the US dollar, but the most punishing metric was inflation.
Right.
Because the European Union had spent years aggressively trying to wrestle inflation down, and this conflict pushed it right back up to an average of 3.0% for the year.
The ECB officially categorized this as an adverse energy terms of trade shock.
Okay, wait. Terms of trade shock. Let's translate that into plain English for a second. That essentially means Europe suddenly has to pay massively more to import the energy it absolutely needs to survive, while the value of the goods Europe exports isn't rising to match that new cost.
Right.
So it's effectively a massive pay cut for the entire continent.
That is an accurate translation, yeah. Capital is bleeding out of the European economy simply to maintain baseline operations. And this creates what the research calls a structural policy trap for the European Central Bank. Because of this energy shock, the ECB was forced to revise its 2026 GDP growth projection down to a mere 0.8%.
Yikes.
The European economy is effectively stalling out. It's bordering on recession.
Now, in a normal environment, the playbook for a stalling economy is pretty simple. The central bank cuts interest rates. They make money cheaper tomorrow to incentivize businesses to invest, hire, and grow. But here is the trap. They cannot execute that playbook.
No, they can't.
The conflict thousands of miles away has spiked energy prices, making that 3.0% inflation incredibly sticky. It just refuses to drop to their mandated 2% target. So if the ECB cuts interest rates to rescue the stalling economy, they risk throwing absolute gasoline on the inflation fire.
Which would completely destroy the purchasing power of the euro. They are paralyzed. The traditional levers of macroeconomic management are neutralized by geoeconomic reality. They find themselves trapped in a stagflationary environment.
Stagnant economic growth coupled with persistent inflation.
Exactly. The central bank, which is often viewed as the omnipotent master of the economy, is revealed to be entirely at the mercy of global supply chains and geopolitical stability.
So when we see the Euro STOXX drop 10% or $1 trillion evaporate globally, it's not the market acting emotionally. It's not a panic driven by scary headlines. The stock market is acting as a ruthless, calculating machine.
That's all it is.
It sees the energy spike. It calculates that European factories will face crippling production costs, which means lower corporate profit margins. It calculates that ordinary citizens will spend a massive chunk of their income just heating their homes, leaving them with nothing to spend on consumer goods. So that 10% drop is a perfectly rational mathematical adjustment to a demonstrably poorer future.
The market is simply discounting future cash flows based on the new, higher input costs dictated by war.
But all of this, the 2022 shock, the 2026 inflation trap, this is based on distant conflicts. What happens to the core European banking system if the structural stress of rearmament continues? What happens if the massive debt required to build these new militaries starts cracking the foundation of the banks themselves? And I think this leads us to the sovereign bank doom loop.
Ah, yes. The sovereign bank nexus. It is widely considered the Achilles heel of the modern European financial architecture. It's a structural flaw that has never been fully resolved since the European debt crisis of the early 2010s.
The scale of this risk is just immense. As of early 2025, European banks hold roughly 4 trillion euros in sovereign bonds.
Right.
That means they hold 4 trillion euros of debt issued by national governments like Germany, France, Italy, and Spain. And that 4 trillion euros equates to 226% of their core capital ratios, specifically their CET1 ratios.
Common Equity Tier 1 capital. Think of CET1 as the bank's absolute last line of defense. It is the core, unencumbered equity the bank holds to absorb unexpected catastrophic losses before it becomes insolvent. It is the financial bedrock of the institution.
Let me use an analogy here to frame why this is so dangerous. Imagine the European banking system is a massive suspension bridge. For the last 30 years during the peace dividend, that bridge was only rated for lightweight commuter traffic. It handled everyday mortgages and business loans.
Okay.
Suddenly, because of this massive rearmament mandate, you were trying to drive thousands of 70-ton military convoys across it simultaneously. The bridge isn't going to politely send you a warning email. The cables are just going to start snapping. Having 226% of your core safety capital tied up in the debt of the very governments that are currently maxing out their credit cards to buy weapons, well, that seems like a recipe for a snapped cable.
The bridge analogy works perfectly because it illustrates weight and structural integrity. Under international banking regulations, specifically the Basel frameworks, sovereign bonds are generally classified as risk-free assets.
Right.
The underlying regulatory assumption is that a sovereign national government will always service its debt because it possesses the ultimate power to tax its citizens or command its central bank to print currency. Because these bonds carry a zero-risk weighting, commercial banks are heavily incentivized to hold massive quantities of them. They park their surplus liquidity in government debt to earn a safe yield without penalizing their regulatory capital ratios.
So they've gorged on 4 trillion euros of this risk-free debt. But wait, if European banks are holding 4 trillion euros in government bonds and those same governments are suddenly forced to borrow hundreds of billions of new euros to meet that NATO 5% rearmament target, I mean, that fundamentally changes the math.
It alters the math completely. If a highly indebted state, such as Italy or Spain, suddenly issues massive tranches of new debt to fund defense procurement, the bond market reacts. Investors look at the deteriorating fiscal position of that state and demand a higher yield, a higher interest rate to compensate for the increased risk of lending them money.
And this is where the trap snaps shut, because bond prices and bond yields move in opposite directions. It's a fundamental law of finance. If the government has to issue new bonds paying 5% interest to attract buyers, the old bonds sitting on the bank's balance sheets, the ones only paying 2%, they become deeply unattractive.
Precisely. Their market value plummets. Why would an investor buy an old 2% bond at face value when they can buy a newly issued 5% bond? Consequently, the market value of that 4 trillion euros sitting on the European banks' balance sheets begins to evaporate.
And because that debt represents 226% of their core capital, a drop in bond prices means the bank's survival cushion is shrinking in real time.
Right. The banks realize they are sitting on massive unrealized losses. As their balance sheets deteriorate, their internal risk metrics flash red. They immediately stop lending to one another in the interbank market because they don't know which counterparty is secretly insolvent.
That makes sense.
They drastically curtail lending to businesses, and they freeze consumer credit. Mortgages become impossible to secure. Small business credit lines are revoked.
And this is the loop part, right? When the banks freeze lending, the real economy suffocates. Businesses can't make payroll, so they close. Workers lose their jobs. Consumption plummets.
Which leads to the fatal downward spiral. As the real economy contracts, the national government collects significantly less tax revenue. Simultaneously, it must spend vastly more on unemployment benefits and social safety nets.
Making the debt worse.
Exactly. This widening deficit forces the government to issue even more debt into an already saturated market, which drives bond yields even higher. The higher yields further destroy the value of the sovereign bonds held by the banks, causing them to restrict lending even more violently. The sovereign drags down the bank, and the bank's failure to lend drags down the sovereign. It is a self-reinforcing vortex of wealth destruction.
That is the doom loop. It's a mechanical failure of the entire system. But, as an everyday citizen listening to this, it's very easy to think, well, high finance is complicated, sovereign bond yields fluctuate, but my personal money is insulated. The government guarantees my savings through deposit insurance.
That reliance brings us to what might be the most delicate, systemic illusion in modern finance.
The numbers surrounding the EU deposit guarantee scheme are astonishing when you actually read them. The scheme legally protects up to 100,000 euros per depositor per banking institution.
Right.
On paper, it sounds incredibly robust. If your commercial bank goes under, the European Union guarantees you will be made whole up to that 100,000 euro limit. But then you look at the actual capitalization of the fund making that promise.
This is the critical part.
The combined funds of the EU deposit guarantee schemes hold a total of 79 billion euros. However, they are legally insuring 8.8 trillion euros in protected deposits.
A coverage ratio of exactly 0.9%.
Wait, less than 1%? Are you serious?
Yes, the system holds less than 1 cent in reserve for every euro it promises to protect.
A safety net made entirely of thread. I mean, if I know my bank only holds a fraction of my money, the only reason I don't run to the ATM and withdraw everything today is because I believe the government will protect me. Is deposit insurance essentially a psychological spell cast by the state? Does it only function as long as nobody collectively demands to test it?
You are describing the foundational psychology of fractional reserve fiat banking. The entire architecture is predicated on sustained public confidence. The €100,000 guarantee is primarily a psychological tool designed to prevent the panic that causes a bank run. And to be fair, that 0.9% coverage ratio is perfectly mathematically sound for an idiosyncratic failure.
Meaning just one bank going under?
Right. If a single mismanaged regional bank goes bankrupt, €79 billion is more than enough liquidity to step in, reimburse the depositors quickly, and maintain the public's faith in the broader banking sector.
But the doom loop isn't an idiosyncratic failure. It's a systemic, synchronized collapse driven by sovereign debt.
Exactly. If a massive geopolitical shock triggers the doom loop, and multiple systemically important European banks simultaneously watch their sovereign bond portfolios hemorrhage value, well, that €79 billion reserve is exhausted in a matter of hours. But the structural flaw goes even deeper than the raw math of the reserve fund. We must ask who is the ultimate final backstop of that deposit guarantee. It is the national sovereign government.
The exact same government whose debt is currently crashing in value and triggering the crisis in the first place.
Yes. The entity legally backing your deposit guarantee is the exact entity that is facing a fiscal crisis and soaring borrowing costs. The guarantee is only as credible as the sovereign standing behind it. If the sovereign balance sheet is compromised by war mobilization and skyrocketing yields, the deposit guarantee transitions from a financial certainty into a legal fiction.
And the central banks are fully aware of this fragility. The research cites a 2025 geopolitical stress test conducted by the Reserve Bank of New Zealand. They built a model simulating a severe geopolitical crisis, and the results were pretty explicit.
They were.
They found that deposit outflows, the speed and volume of citizens panicking and pulling their cash out of the banking system, would be materially higher than what standard regulatory liquidity ratios assume. So the central banks know that in a true geopolitical panic, the psychological spell breaks, people rush for the exits, and the standard regulatory math completely collapses.
Which is why observing the behavior of the institutions themselves is far more instructive than listening to their public reassurances. Everyday citizens might sleep soundly relying on a 0.9% safety net, but the apex institutions that manage global monetary risk are not relying on it. They are quietly, methodically repositioning their foundational capital.
And nothing screams repositioning louder than the historic gold rush detailed in these sources. This isn't just a market trend, right? It's a profound institutional signal.
It is arguably the most critical metric for understanding how the architects of the fiat financial system view the longevity of that very system.
Look at the sheer price action in 2025. The price of gold surged by 50% in a single year. The World Bank data highlights this as the strongest annual gain since 1979.
And 1979 is a deeply relevant comparison.
Why?
Because that was an era defined by massive structural stagflation, energy crises, and intense geopolitical turmoil.
Right. And the momentum didn't stop there. By January 29, 2026, gold reached an intraday record of $5,595 per ounce.
But focusing purely on the nominal dollar price of gold is missing the forest for the trees. The price is merely a symptom of the underlying demand. The crucial variable here is the identity of the buyer.
Because it's not retail investors buying gold coins for their safes. It's not tech companies buying it for circuit boards. It is a massive, coordinated institutional buying spree. Central banks around the world purchased an average of 225 tons of physical gold per quarter from 2021 through 2025.
That is double the acquisition rate observed in the 5 years prior to 2022.
Double. And this aggressive accumulation led to a milestone that genuinely forces a recalibration of how we view global finance. For the first time since 1996, physical gold now accounts for a larger share of global central bank reserves than United States Treasuries.
Let the magnitude of that shift settle. Since the establishment of the Bretton Woods system, and certainly throughout the era of the petrodollar, the debt of the United States government was considered the ultimate, undisputed, risk-free asset on the planet. It was the absolute bedrock upon which global central bank reserves were constructed. To see physical gold eclipse U.S. Treasuries in those vaults is a monumental paradigm shift.
It is the financial equivalent of the Earth's magnetic poles flipping. But why? I mean, Gold doesn't pay a dividend. It doesn't yield quarterly interest. It just sits heavily in a dark vault, costing money to secure. Why are the most sophisticated, mathematically driven financial institutions on Earth hoarding a static metal?
They are hoarding it specifically because of what it lacks. Gold completely lacks counterparty risk.
Okay, let's break down counterparty risk in this context. What does that mean for the listener?
Every other mainstream financial asset in the modern global economy is, by definition, someone else's liability. A
Hmm.
U.S. Treasury bond is a promise from the American government to pay you back with future tax revenues.
Right.
A commercial bank deposit is a legal promise from the bank to return your funds. A share of corporate stock is a legal claim on a company's future cash flows. Every single one of these assets requires a functioning system. They require the counterparty to remain solvent, they require clearinghouses to process the trades, and they require international legal frameworks to enforce the contracts.
But if the global system is under severe structural stress from warfare, sanctions, and sovereign debt crises,
Then you desperately want an asset that is nobody else's liability. A physical bar of gold sitting in a sovereign vault does not depend on a foreign parliament passing a budget. It does not care about a European commercial bank's CET1 ratio. And crucially, it cannot be digitally frozen or confiscated by international sanctions.
like what happened with Russia.
It's exactly. When Western nations froze hundreds of billions of dollars of Russia's foreign exchange reserves in 2022, every central bank outside the G7 learned a permanent lesson about the weaponization of fiat networks. They realized that foreign debt can be canceled by a political decree. Central banks are not hoarding gold for capital appreciation. They are utilizing it as the ultimate geopolitically diversified, stateless hedge against the exact fiat currency system they themselves administer.
It is the ultimate insider tell. It's like, standing in a casino and you notice the casino manager quietly opening the register, cashing out his own chips for physical, unmarked bills, and packing them into a briefcase, all while smiling and telling the players at the table to keep placing their bets.
That's a perfect analogy.
The institutions running the fiat system are diversifying away from it. That is absolute proof they know the debt-fueled rearmament cycle is mathematically unsustainable.
They are explicitly preparing their balance sheets for a world where the fiat architecture and the sovereign debt that underpins it is fundamentally compromised. And the contrast between how the institutions are preparing and how the average household is positioned is stark. The central banks are aggressively rotating into a stateless, sanction-proof physical asset. Meanwhile, what does the average citizen hold?
Right. What did they hold?
They hold local corporate equities, their pension funds are stuffed with domestic government bonds, and their liquidity is held as fiat cash in a commercial bank account.
Every single asset the household holds is structurally exposed to the exact fiat and sovereign risks we just mapped out. The 0.9% deposit illusion, the $4 trillion in toxic sovereign bonds, the doom loop. The citizens are holding the plastic casino chips, completely dependent on the house honoring them, while the central banks are holding the briefcase of physical value.
And to truly comprehend what happens to those household assets when a fiat monetary system is pushed beyond its absolute breaking point by total war mobilization, we cannot rely on theoretical economic models. We must examine the only empirical precedents we possess, the world wars of the 20th century.
Because those eras are the only times we've witnessed this level of synchronized, industrialized state mobilization and the resulting capital destruction.
Right.
If we look at the World War I precedent, stretching from 1914 to 1918, the research details how incredibly fast normal financial operations just vanished. Capital controls were imposed almost instantaneously. Citizens physically could not move their wealth across borders. Major stock exchanges, including those in Paris and London, were completely shuttered for months.
Imagine that today.
Right. Imagine the psychological shock of logging into your retirement account today and seeing a blank screen that just says, "Market closed until further notice."
It represents a total suspension of financial liquidity. The state simply locks the doors to the financial system to prevent capital flight. But the suspension of markets is only the initial shock. The permanent macroeconomic damage is inflicted through the money supply. The sources indicate that the French M2 money supply nearly quadrupled during the 4 years of the war.
Wait, how does a government physically quadruple the money supply, and what does that actually do to the citizen on the street?
The government commands the central bank to literally print currency to purchase government war bonds because private investors refuse to buy them. They flood the economy with newly created francs to pay soldiers, buy munitions, and keep the war machine functioning.
And the result is?
The direct, unavoidable consequence of quadrupling the volume of currency chasing a dwindling supply of civilian goods is hyperinflation.
Mm.
The purchasing power of the currency collapses. France entered World War I as the world's largest net international creditor, possessing vast gold reserves and foreign investments. By 1918, it was a massive net international debtor. The accumulated wealth of a century of empire was effectively incinerated in the trenches over 4 years.
Wow.
For the Parisian middle class, their cash savings, stored under mattresses or in bank accounts, became practically worthless.
So the wealth was transferred from the citizen to the state through the invisible mechanism of inflation. And if we move to the World War II precedent, from 1939 to 1951, we see an evolution, right? The state became much more sophisticated. They didn't just close the markets or blindly print money. They mathematically engineered the financial system to trap wealth.
Yes.
The economic term for this is financial repression.
Financial repression is the blueprint for modern state survival during a debt crisis. During WWII and its aftermath, central banks like the Federal Reserve artificially pegged interest rates well below the actual rate of inflation. Furthermore, they implemented strict exchange controls, making currencies like the German Reichsmark completely inconvertible on the international market.
Let's walk through the exact mathematical formula of financial repression, because this isn't just history. This is the exact mechanism that would be deployed today. It operates as a perfectly stealthy, unlegislated tax on savings.
Imagine an economy where inflation is running hot at 6% annually, driven by massive deficit spending on the military and severe supply chain disruptions. In a normal, functioning free market, the central bank would combat that 6% inflation by raising interest rates to, say, 7%. So if a citizen has money sitting in a savings account, it earns a 7% yield, which protects their purchasing power against the 6% rise in the cost of living.
The citizen maintains their standard of living.
Correct. But in a wartime economy, the national government is carrying a catastrophic debt load. If market interest rates are allowed to rise to 7%, the government's cost to service its own national debt becomes mathematically unpayable. The government would default.
Right.
So to prevent default, the government forces the central bank to intervene and legally peg the interest rate at a much lower level, let's say 2%, even while inflation continues to rage at 6%.
So my savings account is legally capped at earning 2%, but the cost of groceries, energy, and housing is rising by 6% every year. I am suffering a negative real yield of 4%.
Exactly. You are losing 4% of your wealth's purchasing power annually. The state is legally mathematically confiscating 4% of your stored labor every single year to liquidate its war debts. And they achieve this massive wealth transfer without ever having to face the political suicide of passing a formal tax increase through a legislature. It is a quiet, relentless extraction. It is the primary method by which heavily indebted governments melt away the massive obligations of wartime mobilization.
It is brilliantly insidious. Because human psychology is flawed. You look at your bank statement at the end of the year, and the nominal number, the actual digits on the screen, has gone up by 2%. You feel a false sense of security. You feel slightly richer. But when you walk into the grocery store, that larger number buys 4% fewer calories. You are being impoverished, but the mechanism is cloaked in nominal gains.
However, financial repression can only function if the capital is trapped. If an educated citizen realizes they are losing 4% a year to this stealth tax, their immediate rational response is capital flight. They will withdraw their fiat currency and convert it into gold, foreign real estate, or a stronger foreign currency.
Which is why financial repression must always be partnered with capital controls. The state has to lock the exits. During WWII, they achieved this with physical exchange controls. You couldn't legally take currency across a border. But this raises a modern question. We are no longer on the gold standard. Currencies float globally, and finance is entirely electronic. Wouldn't a modern version of capital controls look completely different? There aren't going to be border guards physically searching luggage for hidden bundles of euros.
The physical form changes entirely, but the mathematical and restrictive effects are identical. In fact, a purely digital financial system makes modern financial repression and capital controls vastly more efficient and totalitarian than anything achievable in the 1940s.
Because it's no longer physical, it's just code.
Precisely. To prevent a citizen from moving wealth to a Swiss bank account in 1942 required a massive, cumbersome apparatus of customs agents, physical border searches, and paper ledgers. Today, it requires a single line of code altered within the central bank's digital clearing system. A fully digital, increasingly cashless society provides the perfect, frictionless environment for absolute capital controls.
It's instant.
But financial borders can be sealed mathematically, universally, and instantaneously. The state does not need to confiscate physical assets. It merely revokes your digital permission to transact outside its borders.
Wow. Okay, taking all of this historical precedent, the doom loop mechanics, the gold rush, and the 2025 rearmament data, we arrive at the critical question for the listener. What does the actual timeline look like for your wealth over the next few years? The research provides three data-driven scenarios projecting out to 2027, and it is crucial to state that these are scenarios based on current trajectories, not absolute prophecies.
Scenario modeling is how institutions assess risk. They create structured outcomes based on specific observable trigger conditions.
Let's examine the first projection, which the research identifies as the baseline, or the most likely scenario. This is termed the protracted deterrence phase. In this reality, Russia maintains high-intensity operations, European rearmament grinds steadily toward that massive 5% GDP target, and the EU debt from facilities like SAFE continues to pile onto national balance sheets. No bombs physically fall on Paris or Berlin. What happens to the ordinary economy?
In the baseline scenario, the financial erosion is profound but gradual. We witness European inflation sticking persistently between 2.5 and 3.5%. The euro remains structurally weak against safe haven currencies like the US dollar or the Swiss franc, which steadily erodes the purchasing power of European citizens for any imported goods or energy. Mortgage rates remain punishingly high because the ECB is trapped and cannot cut rates in an inflationary environment. Equity markets suffer periodic, sharp 10 to 20% corrections tied to negative geopolitical headlines.
So for the listener, this is the boiling frog scenario. Cash savings steadily lose real value year over year. The cost of carrying debt like credit cards, mortgages, remains painfully high.
It is a period of relentless, gradual financial friction. The state slowly extracts wealth to fund the deterrence.
This reminds me of the famous Hemingway quote about bankruptcy. How did you go bankrupt? Two ways. Gradually, then suddenly. What this baseline scenario proves is that the gradual part is already active. Financial destruction does not require an invasion of your city. The macroeconomic cost of Europe's military future is currently being embedded into the price of your groceries and the negative real yield on your savings account.
That is the essential takeaway. The friction of war is already priced into your daily life.
But then we must consider the suddenly. The second scenario is the alternative limited escalation by Q4 2027. The trigger condition here is a significant direct military incident between NATO and Russian forces, perhaps a border skirmish, an accidental airspace engagement, or a targeted strike that severely escalates tensions but falls short of total continental war.
The market reaction to this threshold is sharp and severe. The euro would likely plummet 12 to 18% against safe havens in a matter of weeks. European equities would immediately enter a definitive bear market, signaling a drop of 20% or more.
Because the risk premium of being invested in Europe just explodes.
Exactly. Sovereign bond yields in peripheral, highly indebted nations like Italy or Spain would spike dramatically as global investors demand massive compensation for holding risk. And crucially, this is the exact threshold where explicit capital controls transition from theoretical to politically viable. To prevent a catastrophic synchronized flight of capital out of the European banking system, governments would likely institute temporary but severe freezes on cross-border transfers. We would see a desperate flight to physical gold and Swiss francs by any entity still possessing liquidity.
And finally, the research outlines the worst-case scenario, direct conventional conflict on NATO territory. Article 5 of the NATO Treaty is triggered. This is the complete resurrection of the World War II precedent.
In this ultimate scenario, the singular objective of the state becomes sheer survival. All standard financial norms, regulations, and protections are immediately suspended. Stock exchanges halt trading entirely or implement draconian circuit breakers to prevent a total collapse of asset prices. Commercial banks impose strict, legally mandated withdrawal limits to halt catastrophic bank runs. Interest rates are formally and forcefully pegged below the rate of inflation.
Full, unmasked financial repression.
Yes. The real value of cash savings is systematically and intentionally pulverized by the state to continuously fund the war machine. Property values in projected conflict zones collapse to zero, while surging in perceived neutral or safe haven regions. The entire financial architecture of the continent is weaponized purely for state survival, completely subordinating the financial health of the individual citizen.
Let's synthesize the sheer scope of what we've mapped out today. We began with the stark reality of Russia dedicating 7.5% of its GDP to its military, forcing Europe into a frantic scramble to hit a 5% rearmament target by 2035.
A historic pivot.
We examine how those hundreds of billions of dollars in rapid defense spending create a colossal debt burden, acting as a vampire on aggregate societal wealth by redirecting capital away from productive infrastructure. We looked at the live, empirical stress tests of 2022 and 2026, proving that distant conflicts instantly rewrite global energy costs, spike domestic inflation, and trap central banks in a stagflationary paralysis where their traditional tools are useless.
We trace the mechanics of how that macroeconomic stress infects the core banking system through the sovereign bank doom loop. We saw a banking sector holding 4 trillion euros of fragile government debt, ostensibly protected by a deposit guarantee scheme that possesses less than 1 cent in reserve for every euro it promises to protect.
We watched the apex institutions, the central banks themselves, quietly hoarding physical gold at a record pace of 225 tons a quarter. They're actively diversifying away from the fiat system they control, seeking a stateless, counterparty-free asset, while the average citizen remains fully exposed in cash and domestic equities. And we analyze the historical precedents of the world wars, demonstrating how the state utilizes inflation, financial repression, and capital controls to mathematically extract wealth from the populace to fund mobilization.
It is a comprehensive, mechanical mapping of how macro geopolitical trauma transmits directly through the financial plumbing into the household balance sheet.
If there is a singular truth you take away from this deep dive, it is that compartmentalization is no longer possible. You cannot look at a map of a distant conflict and say, well, I'm not a soldier, the front lines are 1,000 miles away, therefore I am insulated.
You are not insulated.
Financial consequences of Europe's military rearmament are not abstract theories, and they are not waiting for a formal declaration in some distant future. They are currently actively pricing into the markets you rely on. Your stored labor, your savings, your purchasing power, your money is already intimately involved in this geopolitical shift, regardless of whether you consent it to it.
The mechanisms of massive wealth transfer from the private citizen to the state are already engaged.
Which leaves us with a deeply unsettling final thought. We discussed how the central banks are aggressively buying physical gold. They are recognizing the systemic fragility of the sovereign debt loop, and they are physically opting out of the counterparty risk inherent in the fiat system.
Yes, they are.
But if the world's most powerful, legally protected financial institutions feel compelled to physically hoard gold to survive the system they manage, what is the everyday citizen's equivalent of opting out? And more terrifyingly, as we transition into a fully digitized, interconnected banking system where a single altered line of code can freeze a border and trap your capital, is even mathematically possible for the individual to opt out anymore.